we moving to another question. You realize this is a bit more complicated. Go through it quickly. This question includes few things that you didn't see in the previous question. Here we have to compute tax, because this is cash flow in pre-tax form, right? There's also residual value that we have to consider. So there will be either profit or loss on disposal of asset at the end of life. Likewise, there's tax depreciation that we have to treat in this question, and management fee is also here, as you can see, which is like royalty. Remember those adjustments that we discussed in the lectures when we're looking at the theory. Now you are seeing it in questions real, right? So there's a 2 million management fee like royalty. So you see how you treat it in question, both in foreign currency side and also in the parent side. It's an intercompany transaction. Usually you expect it to eliminate, but because of the complexity with the exchange rate, it will not eliminate perfectly. So you need to treat it in the foreign cash flow and treat it right in the parent. Parent, it will be an inflow because an income, and parent will pay tax on it. For the foreign cash flow, it will be an expense and it will be deductible before the profit before tax, right? And likewise, there is a part of tax treaty understanding that needs to come in here. See, UK tax is at 30%, whereas Farland is at 20%. So tax treaty exists here, and there's an extra tax of 10% that the parent will need to suffer. So all of that are the additional complications that I've built into the next question, and we're going to look at it. Like I said, the next one will even be more complicated, and I hope you're enjoying it. So let's deal with this one quickly. So we have year 0 to year 4. And I know you understand why we're going to have year 4. If you are wondering why, yes, the cash flow is year 1, year 2, and year 3. However, in the UK, tax is paid in arrears. So there will be tax payment that will spill into year 4 in the UK. So that is why I have to have year 4 ready. Okay, so let's start with the pre-tax cash flow that we're given. So this is pre-tax cash flow, trading cash flow. That has been given. Year 0, there's nothing happening there. Year 1, 35. So we're dealing with P&L. I know year 0 there's initial outlay, but when we finish all the P&L, we can just bring in the year 0 initial outlay. So don't worry, we'll come to that. So, but there's no trading in year 0 because that's now. So these are the cash flows that will come in pre-tax, year 1, year 2, and year 3. Now we need to make all the necessary adjustments. Let's start with the profit on sale of asset at the end of the asset life. Or maybe we should do depreciation first. Let's do tax depreciation. Tax depreciation. Remember, depreciation will be allowed by tax if it is done on a straight line method. So 81 divided by 3 will be our depreciation, and it's negative because it's a deduction. So that's what we have for 3 years. That will be the depreciation figure. And at the end of life of the asset, it will come to 0 because a straight line depreciation, it's one going down. Please don't get confused with the residual value of 10. It's not that the value of the asset will be 10 that is undepreciated. This is saying that the asset will be sold for 10 million at the end of the project. So which means for asset that is worth nothing, sold for 10 million, that will be profit on disposal. And that will be the total 10 million. So you're going to make 10 million on disposal. That's the profit. And it's just the same thing as the cash flow. So even if I adjust for it later, it's going to be in and out, but I will still do it so that you get used to the format. There's a management fee of £2 million. Which this company will have to pay. But guess what? We can't put pounds there because remember, all these cash flows are in FFI. So which means that management fee of £2 million, we need to convert it to FFI. And that tells you that we need to know what the exchange rate will be for each year. So for year 0, spot rate has been given to be, where is it? Let's look for it quickly. The spot rate is given to be 5 FFI per pound. So 5. But for the subsequent years, we need to know what it will be. And you probably can see that inflation figures have been given for both UK and Finland. In UK it's 4, in Finland it's 7%. So purchasing power parity will hold here, and that means the forward rate will equals to spot rate multiplied by 1 plus rate in the first currency, which is 7%, that is the inflation rate, divided by 1 plus inflation rate in the UK, and that is 4%. And that will give us the exchange rate for year 1, the same thing year 2 to year 4. That is what is going to happen, right? Remember, for year 2, spot will be year 1. For year 3, spot will be year 2. For year 4, spot will be year 3. I'm sure you are getting used to that already. So if 5.1 FFI is equivalent to £1, what would £2 be equivalent to? That means that will be equals to £2 multiplied by the exchange rate. And that means for the 3 years, that is what we will be paying in foreign currency, FFI. But remember, it is an expense, so it has to be outflow. Please remember, get used to that. I don't want you to make that mistake. So those are all the adjustments that we have to make before we arrive at the final PBT in FFI currency. So which means our PBT will be total of all of that. That's minus 2.28 for year 1 and for all the other years, just like that. And I hope it's all making sense as we're progressing. So now that we have the PBT, we can get our taxation. And taxation is at, the total is at 20% in Finland. So that's 0.2 multiplied by the profit before tax. No, in year 1, there will not be tax because there is a loss. Very important. And that is why I taught you this method. That this method, you have to use it in AFM, because in your FM days, you will not deduct this here. And you will have thought there will be tax, because even if you deduct 35 minus 10, you will still have positive PBT, and you would have charged tax, and your calculation will be wrong. In reality, tax deductions are deducted before taxations are paid. So that's why you have to bring it in, then you can adjust for it later to arrive at your real cash flows. Right, so, and look at this question. It made us know that any losses are carried forward and netted off the first available profit for tax purposes. So which means for year 1, there is no tax. For year 2, there will be tax because there is a profit, but we need to first of all net off the loss. So let's net off the loss from the profit. Then whatever it is left will be taxed at 20%. So which means, well, negative because it's outflow. Yeah, so that is going to be the tax. And we're going to pay tax on this one as well at 0.2. Very good. So we have our taxation, then we can get our profit after tax to be equals to cash flow minus tax. So we can just do that. Yes. So that gives us the figure for after tax. Now, this is finance management. What this means is that we are not going to be using profit after tax to discount, because we need to use cash flows and not accounting profit. We cannot use accounting profit. And I hope you understand what that means. What that means is that we need to adjust for non-cash flow items. So we need to take away non-cash flow items that is already included in the profit after tax. And what are those ones? So let's do our adjustments. The first one is tax depreciation. It's not a cash flow item, so we need to remove it from profit after tax. So we need to add it back. So add back tax depreciation. So we're going to add that back. That's number one. Number two, profit on disposal is not a cash flow item. It might be easy here because it's in and out, and say you don't want to adjust it. Get used to the format. So I'm going to take it out. Yeah, we need to take the profit out. What we need is the proceeds, which is the cash. Luckily, the proceed here is 10. The question has told us 10 million will be realized, so that's 10. I think that's all the cash flows adjustments that we have to make. And once we do that, we can add our initial outlay as well. Initial outlay is negative 81. So which means with this, we can get our final cash flows in FFI, which is what we eventually convert to the parent currency. So we have that. So minus 81, 24, 61, and 44.6. Yeah, so this is a cash flow that we're talking about in foreign currency. However, we need this cash flow in GBP. And for us to get that, we need to convert using the exchange rate, which we already have here. So we're good to go. So all we have to do is to convert the FFI to GBP. And we know that for year 0, 5 FFI is 1 GBP. So to get what GBP will be, we need to divide by those exchange rate. So this equals to that divided by the exchange rate. We already have it. And that goes for all the years. So we have the GBP cash flow ready for use. Now, this is where we build a bit more complications again, because this is the cash flows that are coming from the international investment, but also there are additional relevant cash flows as a result of that decision that will be incurred or benefited in the UK by the parent company. And that's what we need to adjust for now. The first one is the management fee that will be earned, and that is 2 million every year. 2 million pounds every year. So we need to put that in. There will be tax on that management fee because it's an income. Yeah. But they told us that tax is paid in arrears in the UK. Yeah, they told us that. So because tax is paid in arrears, then it means that this tax will be paid in year 2 at 30%. So this will happen here, and year 2 will pay in year 3, year 3 will be paid in year 4. So those are the taxes. The final adjustment in this question in the UK is the UK extra tax. Extra tax. And I'm sure you remember why there will be extra tax, because in the parent country, the tax rate is more than the foreign investment. And because of that, there's extra 10% of tax that needs to be paid. Yeah, so if I put it here, that is 20%. That's coming from 30% minus 20%. So that 10% extra tax will be paid. So which means the PBT that we have earlier on, we need to know what the pound equivalent will be and charge extra 10% on it. and that extra 10% will be paid in arrears, remember? So take, for instance, we have a PBT, is our PBT line, but there won't be nothing will be paid here for sure. Nothing will be paid because it's a loss, but the payment will start for this year too. But even the payment in this year too will be paid in arrears, and that will be paid here. So if I come down here, this is where the tax will be paid. So first of all, the total foreign PBT that we're talking about is that plus this. But this figure is in FFI, and we need to convert it to pounds. And to convert it to pounds, we need to divide by the exchange rate that is applicable for that period. So if you look at it, you will discover that the exchange rate that we should be looking at will be the second year exchange rate, because it's year 2 tax, just that we are paying in that period. Yeah, so this is actually the PBT that we're talking about in pounds. So this PBT will incur additional tax at 10%. So it's cash outflow, so I'm going to put negative. So that is the first extra tax that will be paid. And also on this 22, there will be extra tax as well. So we also need to convert that figure to the GBP and charge tax at 10% extra on it. And that is extra tax for that. So with all those adjustments, we can come to calculate the final, or we'll call it total cash flow in GBP. So that will be equals to all of that. Yes. Up to year 4 rather. So it looks pretty easy at this point, because now all you need to do is to get discount factor at the UK discount rate, and that was given at 11%. You can as well use calculator. I will show you both of them. So this is year 0, discount factor is 1. This will be 0.901. This will be 0.812, 0.731, and 0.659. And we can get the PVs, which is cash flow, multiplied by the discount factor. Adding all of that together will give us the NPV that we have been talking about. So for this investment is 6.29. That is the NPV. Yeah, definitely good investment. We have to do it because it's positive. If you want to use Excel to calculate it, remember, I always like to show you that is equals to the value as at today plus the NPV of the future cash flows at 11%. I should be the cash flow. And this one should be the same figure, but let's be consistent. Yeah. It's the same as you have. 6.28, 6.29. Yeah. This is Excel. This is manual. Yeah. So that is it for this question. I hope you enjoyed it. We'll keep going gradually. Stay tuned for the next question. Like I told you, that will even be more complicated as well. But I hope you are following through gradually. Please try and attempt these questions by yourself. Watch the video and try and do it all by yourself. Don't just watch the video and feel you understand and you abandon it. Please try it on your own without the videos and use the video to mark yourself again to see whether you really pick all the concepts. Let's keep going.